Welcome back, Governor.
It's good to be back. A lot's happened
By
in a
popular
year.
demand.
A lot has happened in a year.
A lot has happened in a year. I was thinking about that. So this time a year ago, we were talking about soft landing, right? You had inflation under control. We had a crisis, a productivity crisis. Now we've got an existential crisis. I don't know, what fresh hell do you think we're going to usher in this year?
Oh boy.
I didn't necessarily mean you have to answer that, but if you'd like to, keep going.
Well, I will just sort of review where we were last year. I mean, last year at this time, honestly, I was feeling pretty good. You know, we'd got inflation down. Inflation was 2%. We had started bringing interest rates down. We were starting to see some green shoots. Growth was starting to pick up, and it did pick up through the end of the year and even into the start of this year. Unemployment rate was coming down. You know, nobody said we could engineer a soft landing. I was feeling pretty good. Yes, we had a 25-year productivity problem, and after 25 years, yeah, you got to declare this isn't just a problem, it's an emergency. So there were, you know, we were leaving a lot of money on the table as a country. There was a lot of things we could do to increase our growth rate. You know, the difference a year makes is, you know, now we're not looking at foregoing an opportunity. Now we're trying to get back to where we were. Actually, I heard a great new word over lunch. We're not trying to get back. We're trying to, you know, what was it? What was the word at lunch?
Bounce forward, right?
Bounce forward. Yes,
bounce back.
We got to bounce forward.
Well, let's get to some ideas about how we might bounce forward a bit later. But I want to pick on that, and we pick up on how bad it feels. Certainly, in the months following our conversation last year, it started to feel really, really bad. Liberation Day came, and everything it looked like it was over. Here was the next global recession facing us, but that didn't happen. Right, the global economy is still okay. Right, everybody's sort of starting to revise up their growth estimates. Markets certainly are undaunted by anything that they're seeing. So, I mean, you have lots of conversations, obviously, given what you do and how long you've been doing it. You know, a lot of people out there, you're talking to people all the time. What is going on in the global economy? I mean, and maybe the other way to ask that question is do we overreact to tariffs? Maybe are they as bad as we thought they were going to be? Maybe this time, you know, in January or February.
Well, the level of tariffs that is in place, of U.S. tariffs that are in place, look, they're not nearly as high as they were on April 2nd, but they're the highest they've been in 80 years. More than 80 years, since the 1930s. So no, I don't think we're overdoing it on tariffs. You know, if you look at the global economy, you're right. It has been impressively resilient to the tariffs, to the uncertainty created by dramatic shifts in U.S. policy. I mean, the IMF has revised their growth down a bit since what they saw a year ago. So have we. For globally. But yeah, top line growth is not so bad. I do think this is going to be a structural adjustment, and I'll come back to that. And so you're going to see the effects play out over time if there isn't a change. And you can already see, if you look at specific areas, particularly trade, you can see the effects quite dramatically. I mean, exports of other countries to the United States, particularly China, the European Union, and Canada, down sharply. You are seeing, at the same time, you're seeing countries trying to increase their trade with non-U.S., with other countries. China has very impressively actually pretty much filled, they exports the U.S. down a lot. They've increased their exports to Southeast Asia, to Europe. It's largely replaced the lost. Now for Canada, that's a lot harder. 75% of our trade is with the United States. You do see some increase in our trade with other countries, but We can't replace 75%. And then the other, so you're seeing U.S. imports are down, and what they do import is going to be more expensive in the United States. The U.S. thinks this is going to improve their trade deficit. It might in the short run, but fundamentally, unless the U.S. saves more, it's probably just going to reduce exports along with imports. So the U.S. footprint in global trade is going to be smaller. The world needs to adjust to that. Now, Canada, for us, it's a bigger adjustment than it is for any other country because we are so integrated with the United States. Our actually average tariff rate with U.S. is comparatively low, 6%, around 6%, which is low by global standards. But as I said, 75% of our trade was from the United States. Our economies are so integrated. Many products are produced across the border multiple times before they're a final product. So yeah, it's going to be a bigger adjustment for us than for anyone else.
Do you not anticipate that eventually the corporate Canada, the business, the private sector will just figure out a way to get around those tariffs, through those tariffs, absorb those tariffs? I mean, profit margins were pretty wide going into this period. Is it not possible that people just might accept lower profit margins, lower hurdle rates, that sort of thing?
Well, I mean, look, businesses, I'm looking at a bunch of business leaders. Yes, many businesses have absorbed some of that on their margins. In fact, there's a big question, who's actually paying for the tariffs? And if you look at the data, what you see is actually, so far, it's largely American companies that are playing with the tariffs. Yes, they did have pretty good margins. They have largely absorbed the tariffs. Some of it has passed through to consumer prices. You can see it in certainly some items in the U.S. CPI. But will they permanently absorb those tariffs? I doubt it. I think over time they will pass those through. And if you look historically, that's what happened. The pass-through tends to be slow, but yes, businesses are going to look at ways to restore their margins.
All right. I've got one last global question before we get to some domestic issues. Everyone is talking. We mentioned the stock markets in passing. Everyone is talking about an AI bubble. You have some experience with financial crises. You were at finance, closely involved in the work done there to fight off that calamity. Something that you told me when I came to see you on the 10th anniversary of that event, when you were still at Rotman, you told me about how one of your visceral memories was in the early stages of that event, walking the streets and just sort of being almost torn up, I guess, is what I remember you saying about seeing all of us not really having a clue what was happening, and you having all that information about what could happen. You didn't know how bad it could get, obviously, but you obviously were privy to some information about how bad things could get. How does it feel walking around the streets today?
Yes, you do have a good memory, Kevin. It's unfortunate. I don't feel like I felt then. I think this is a slower moving issue than it was in the global financial crisis. And certainly we've invested a lot in the last 15 years in creating a more resilient, better capitalized financial system. I mean, we already had most of that in Canada, but globally, clearly we didn't. And just to go through, the financial system actually has been remarkably resilient globally through the last 5 years. That's something we can be thankful for. What worries me the most is that you just showed some polling of Canadians. Canadians are clearly worried about the cost of living. We did have a big increase in inflation. We've got inflation back down, but the price level is higher. People don't pay inflation, they pay prices. They're still feeling the impact of that going forward. They're still feeling the impact of that past inflation. It hasn't gone away. It's got a long tail. So what can we do about that problem? Well, our mandate is to keep inflation close to 2%. So we're not going to push the overall price level back down. And in fact, if we tried to do that, it would be very bad in our economy. That's what causes Great Depressions. That's why we target inflation. But so the question is, okay, so what's going to make it better? Well, the only thing that's going to make it better is to grow our income. If there's more income, things become more affordable, but that is going to take some hard decisions. That is going to take some time, and it gets to this polling. Canadians are it looks like they're ready for some hard decisions, but it's going to take some perseverance.
So let's talk about what you can do, or the central bank can do at this moment. You cut interest rates a second consecutive time last week. But you said pretty clearly that this is it. You're done, unless things get, go way, way, way off course. You need to stop there. Why?
Well, this really comes back to where I started. What we're seeing now, it's not a normal business cycle. A normal business cycle, growth goes down, then growth actually typically comes above its longer term trend. You fill in the hole, and then you get back to the trend. This is more like growth goes down. Yeah, growth will come back up, but the level is lower. I mean, to put that in words, look, we've had an entirely open trading relationship with our biggest trading partner. That is over. It is fractured, and that is destroying some capacity in this country. It's destroyed some productive capacity. There are also additional costs. We talk to companies all the time. What do they tell us? Well, yeah, they're looking for new markets. They're looking to diversify their markets. They're looking to develop new products. They're reconfiguring their supply chains. But the other thing they tell us is that all costs money. That's adding costs. Somebody's got to pay that cost. So we've got two things going on. We've reduced some of the productive capacity of the economy, and we've added cost. That limits what monetary policy can do to boost demand while keeping inflation close to the 2% target. So yes, there is a role for monetary policy to help the economy through this. But we can't target the heavily tariff sectors. We can't target steel or autos or aluminum or lumber. We can't help companies develop new markets or reconfigure their supply chain. What we can do is, obviously those hard-hit sectors, that is spilling over to the rest of the economy. We can use interest rates to try to mitigate those spillovers, and we can, by lowering interest rates, we can help with the adjustment. And, investment is the cost of borrowing for investment is a little bit lower. But as I said, it's how much we can do is limited by the fact that there are added costs. There is destroyed capacity, so there's only so much we can do.
You typically shy away from being too explicit about your intentions for monetary policy. Certainly for the last while, it's sort of you've emphasized that you're data dependent. Why now have you shifted to a more explicit, what we say in the biz, forward guidance? So was there something behind that?
Well, these are always difficult judgments, but you went back to the start of first U.S. threats on tariffs, then April 2nd, and we've been consistently putting out what we called scenarios, because you can't do a forecast when we couldn't, with that much unpredictability. We didn't feel it was really helpful either for monetary policy or for the public to put out a forecast. But those scenarios certainly were very helpful for us, and they showed just if you got a 10% universal tariff in Canada, yeah, we were predicting the economy would have a serious recession. If we could negotiate back from where we were, that recovery could be a little bit faster. But even in that scenario, we weren't getting back to where we were. And from the beginning, I have been talking about, to use a sort of economist jargon, this isn't just a demand shock, it's also a supply shock. And supply shocks are more complicated. Monetary policy can't stabilize inflation and output at the same time, so there are these limits. And I've been talking about that, but it's been kind of a theoretical statement. But now it's become, we feel that with our interest rate at the low end of what we call our neutral range, it's providing some stimulus. That is helping with this adjustment. But yeah, I mean, based on, and I would underline the conditionality of this statement, based on our current outlook with the current tariffs that are in place, yes, we think monetary policy is in about the right place to provide some support while keeping inflation well controlled. We've also said, look, if the situation changes, we're certainly prepared to adjust. We recognize there's still a lot of uncertainty. Every business, you're all facing it.
How would you describe your confidence that you do have inflation under control? I mean, you talked about how the cost of living isn't going to plummet, and we don't want it to, but you feel like you've got at least the rate of change under control based on your latest communications. But what sort of confidence level would you attach to that?
Look, we're worriers. We always worry. So, I mean, looking at inflation, headline inflation has been close to 2% for about a year. If you look at what we call our preferred measures of core inflation, which try to strip out some of the volatile components, they've been sticky at around 3%. So we are, and you can see some of those cost pressures that I talked about coming through. We look at a whole range of indicators beyond these preferred measures of core. They tend to be running a bit below core, but our assessment overall is still underlying inflation is about 2.5. So that is a bit of a concern. And what you worry about is that headline inflation is going to adjust up to those rather than those adjusting down to 2%. I think on the more reassuring side, earlier in the year, we did see some upward momentum in those, by which I mean if you look at sort of the monthly, 3-month, 6-month measures, they were running 3.5%. They've now come down a little under 3. So some of that upward momentum we saw has come out. It takes a little while for that to show up in the year-over-year numbers. We think that that upward momentum is dissipated. We think there's going to be some more easing. But look, this is a structural adjustment. We don't go through these very often. So yes, there is an abnormal amount of uncertainty about how this is going to play out, and we're watching that closely. Look, our priority is to make sure that the tariff problem doesn't become an inflation problem.
Okay, we got about 5 minutes left. I could do this all afternoon. Let's make sure we talk a bit about the bounce forward and how we might bounce forward. You've set out fairly clearly that because of all the things we've been talking about, you're sort of limited in what you can do from where you sit at the central bank. But you know a lot about the economy. You've got a PhD from the school that just gave us a Nobel laureate in economics. He wrote about innovation. You have some thoughts, surely, that you could share about how you would go about sort of orchestrating a more resilient economy in this moment without getting yourself in too much trouble with the folks on the other side of town in Ottawa.
Well, first of all, I'm glad you mentioned our Nobel laureate, Peter Howitt, who actually taught me when I was a graduate student at Western. Great Canadian moment. And it really does, I'm looking at 2 university presidents. I am the former dean of the business school. Our universities, they are gems. They are a real Canadian gem. And one bit of advice for everybody is we need to support them. But yes, coming back to the bigger question, look, we've been kicked. And we've got some bruises. And, you can kick back. Sure, that feels good. But what do you really need to do? You need to strengthen the team. And you need to win. That's how you bounce forward. So, look, what does that look like? I will stress, these are not things the monetary policy can do. They're not things within our mandate. We do spend a lot of time looking at the economy. We can help with the diagnosis, but when it comes to the specific policies, I'm going to leave that to our elected governments. But look, you just look at a map of North America, Canada, the U.S. Canada's a long way across, and it's been so much easier to just trade north-south, north-south, north-south. And as a result, we've underinvested in developing our internal market. We have too many interprovincial trade barriers. We have all sorts of provincial accreditation bodies for almost every plumbers, electricians, doctors, nurses, engineers, you name it. You can move, but there's added friction. We have small regulatory differences across provinces. Yes, they're well-intentioned, but we can get rid of that. And I think you are seeing some real political momentum to do that. I do worry that it's a bit too piecemeal. And I mean, the objective here is to lower the cost of doing business across the country and growing our internal market. A comprehensive approach would be much more effective in achieving that. The other part is that we need to improve our east-west transportation so we can move things more inexpensively across the country. And then if we want to diversify our exports, well, we need to get things east-west. We need to improve our port capacity, and that will help. So those are some of the things that I think where it's been so easy to go north-south, we need to be thinking more globally.
What's your sense on what's happening with the push to get rid of some of those inter-provincial trade barriers? I mean, I've listened to you talk about that for years, far before this current moment. You spent a lot of time talking to businesses, people out there. Well, what's your sense on where that's at? Is it still proceeding?
Well, as I said, look, I think on the positive note, these have been around for a long time, and previously we were missing an upside opportunity. Now it's we need to grow our internal market to offset what we're losing in the American market. So that has created there's something about losing something feels worse than giving up something you could have had but you don't have. So that is creating some political momentum. And certainly the provincial premiers are engaged on this like they've never been before. As I said, I mean, what we're hearing for businesses is, so provinces have been signing a series of MOUs with each other. What we are hearing from businesses is, okay, well, that's great, but now we have to sort out all these MOUs. Like, there's still a lot of rules. If you could take a more comprehensive approach, that would be more effective in lowering the cost of business.
Okay, we've got 1 minute left, so AI. Yeah, I know. How are you thinking about AI? I mean, maybe that's the way we can do it. What's your mental model for thinking through this moment?
Well, I will say with some trepidation, I usually feel like when I talk to people, I know more about monetary policy than most other people in the room. But on AI, I'm not sure that is the case here today. Look, I think we've talked a lot about we need to improve our productivity growth. We need to grow our economy. Productivity growth is what underpins rising standard of living. It's what pays higher wages and what makes your companies more competitive. So that is the imperative, and AI has the potential to be a big part of that. So that is something we need to lean into. You talked about Peter Howitt. So his Nobel Prize is on sort of formalizing the Schumpeterian idea of creative destruction. AI, transformative technologies can destroy businesses as well as create new ones. They can eliminate jobs as well as creating new jobs. That can be a painful adjustment for the economy. So as you think about that, you don't want to eliminate the top line potential, but you got to think about how are we going to, as a country, manage through the disruption as well. And the reality is, if you don't allow any disruption, it's going to be hard to get the top line. So you can't block the disruption. But you do have to figure out how to ensure that the losers can move on, get some retraining, find another opportunity. So I mean, the last thing I'll say on AI is that we also have to look at longer run. There's potential for big payoff. It should be disinflationary, meaning the economy can grow faster without causing inflation. In the short run, though, and you're already seeing this, there will be some bottlenecks. I mean, there's been a huge increase in demand for power, particularly in the U.S. That is causing bottlenecks. So you will see pressures in some places. So we need to look at both the demand and supply, and our job is to try to keep the overall economy in balance. So that's what we're looking at.
Thanks for that, Governor. And we're out of time. Thank you very much. Thanks, everybody.